This is Logical Logistics, where we cover shipping, supply chain, logistics, and everything in between. Welcome to the show.
Hello, everybody. It's Joe Becht once again from Logical Logistics. Today, our guest is Thomas Eickleberry. I can call you Tom, correct?
You sure can.
All right, and you are with you're in the real estate profession, which we're going to talk about.
I am. I'm the broker owner of Pride Street Realty. We're a Texas-based brokerage, Texas licensed broker. We work out of the Houston area.
Okay, so what are you seeing on your end? Houston's comparable. I'm in Chicago, and you have a comparable population, although a different, obviously, geographical situation. But what are you seeing down there right now in light of everything that's happening with the COVID-19 and the coronavirus?
Well, we're seeing real estate took a real punch in the mouth, and real estate always kind of takes the first hit in any downturn in an economy, and then everything trickles down through real estate into building supplies, the financial sector, down to the individual consumers. So we're hurting right now, no doubt about it. No reason to try to gloss it over. We're hurting.
Right. Yeah. No. And that's common with a lot of businesses out there. So a little bit, just before we go back into the nuts and bolts on where we're going to go from here, can you give a little background on yourself? How you got into real estate? Yeah.
Yeah. Well, I grew up in the Midwest. I was always in the customer service sector.
And what part of the Midwest?
Primarily in hotel and restaurant business. And 30 years.
And where in the Midwest? Since I'm from Chicago, we always
St. Louis.
All right. There you go. Well, I'm a White Sox fan, so I hate the Cubs, and so I always find a common bond with my St. Louis brethren there. That
yeah. Well, we've always enjoyed the rivalry between our Blues and our Blackhawks. That's always been a lot of fun.
Oh man, those old games at the Checker Dome were insane. We used to go down there. Yeah. So go on. I'm sorry.
No, I always remember those days. I'm 55, so I have a history with the rivalries between St. Louis and Chicago. It's always been good fun.
Yeah.
And I started my career as I said, in hotel restaurant business, and then eventually from there, I got on the bandwagon working with chefs of some notoriety. I've worked with some pretty good ones over the years, and then I found myself coming to Houston in '99, where I continued my career in restaurant business. And then, like anything else, you just kind of hit that ceiling of income potential. And by luck, some family members said, you're basically in the service industry now, here out. Why don't you try your hand at real estate business? And I never really thought about real estate business as being customer service oriented, but I quickly saw the light that it is a customer service oriented business. So I got my real estate license 11 years ago. Started working for a family business that eventually dissolved because everybody just retired. And then I went to work for another brokerage here in Houston, built that brokerage up to about 600 agents in concert with the sponsoring broker. And then a year ago, I decided I got sick of making other people rich. And I thought, well, why don't I try to make myself rich?
Yeah.
So I stopped working as a sponsored agent, got my broker's license, and breathed life into Pride Street Realty. And that's where we are now.
Okay. Very good. All right. So the coronavirus / COVID-19 hits about a month ago. I mean, it really hit.
Mm-hmm.
I remember I was actually in Tampa visiting one of my sons, and we were scheduled to go to a couple sporting events, and all of a sudden everything just got shut down, and it's gone on from there. So you mentioned how it's affecting real estate, and that's one of the hardest things to get hit first. Can you elaborate on that a little bit more?
Well, real estate, it can be a very fickle business. Real estate likes when things are firing on all thrusters, and when one aspect of the economy starts to limp, we feel it throughout real estate. Real estate is, of course, a personal business. It's primarily focused in the residential. I do residential and commercial, but for the purposes of today, I'm just going to focus on residential. Right now, with everybody being out of work, it's people are wondering how they're going to pay their mortgage. So now the financial sector is going to have to focus on how to keep their borrowers from going into default.
Correct.
And now, in addition to that problem, now we have folks who are opting to not get in to contract on purchasing a home. So now the buyers are starting to have second thoughts about extending themselves into a 15 or a 30-year mortgage, extending themselves into that commitment. And then that directly affects the sellers. If the sellers don't have any buyers, then basically you just got a bunch of houses all over Harris County with signs in their yards.
Yeah.
And but what I was saying as far as real estate being very fickle, if you think about real estate and how many different aspects affect real estate on the supply side, whether it's building materials on the supply side, or in the case that we're dealing with now, it's liquidity. There's money to be had, but buyers aren't wanting to borrow the money because their supply side of money has dried up. So I want to make it real clear that the mortgage industry is still here, and they can operate remotely. We don't have to sit in offices. Anybody can get a mortgage loan today if they want one. The qualifications are still the same. Nothing has changed. It's not like with COVID-19, now suddenly you have to have an 800 credit score in order to qualify for a mortgage. It's not that case at all. There are lenders that are writing mortgages for borrowers who have a 580 credit score if they want to buy a home through an FHA or a USDA guaranteed loan program, government-backed mortgages.
So it sounds like we're in a buyer's market all of a sudden.
We are, and I'm glad that you said that, because that's where I've been going with all of this.
Yeah.
When I've been thinking about talking to you, is we are entering into a buyer's market now because inventory is out there. Lots of people want to sell their homes, and builders are still more than happy to build, and they are building. But now we've lost our buyers. So, yeah, absolutely. All of the things that create a perfect storm in real estate that would bring us to this point of being now in a buyer's market from what has been a seller's market for over a decade. We are definitely
and obviously
now in a buyer's market.
You think back to 2008, and I just wanted to ask you, what are the similarities and what are obviously there's big differences, because in 2008 a lot of people did the wrong thing, where today this is something that just came out of left field. And
Agreed.
Yeah.
But the result is going to be the same.
Okay.
In 2008, as you rightly brought up, mortgages were extended to borrowers who never in a million years qualified. The lending institutions created pathways to make it possible for borrowers who under normal circumstances would not have qualified for a mortgage, but made it so that they did. And in this case, just 1 point, the adjustable rate mortgage, when that ARM expired and the interest rate went to what it probably should have been when the borrower initially came in and applied for the mortgage, the interest rate went up, in turn the monthly payment went up, and then suddenly borrowers couldn't afford their house payments anymore. That was the biggest thing that borrowers in 2008 seen, where for the first, we'll say 5 years they were in their home, their mortgage was $1,000 a month. then that 5-year arm expired, and now suddenly their house payment is $1,500 a month.
Yeah.
And now they can't afford their mortgage anymore. And then everything else that was going on in the global economy just again, a perfect storm, just took the feet right out from underneath them. But the initial thing that they foreseen was that their mortgage payment went up when the interest rate went up to the higher rate. What we're seeing now is the rates haven't changed, but what we're seeing now is buyers just don't want to make that leap into a mortgage, and many of them won't be able to because a lender is not going to approve a mortgage for somebody who has been furloughed.
Yeah.
Or somebody who is now been reduced to a part-time worker.
Yeah.
The flow of cash to the consumer has stopped temporarily, hopefully very, very temporarily, and the underwriters' qualifications have not changed. They look at the borrower and they ask the borrower, well, where do you work? Well, I used to work. Right now I'm furloughed. Right now I'm without a job.
Yeah.
So the underwriter's going to say, well, call us when you get back to work. As for the ones who still have their jobs, it's understandable that they're asking themselves, well, how long will I have a job?
Yeah.
Will this continue longer than what we hope it will? And in a month from now, 2 months from now, we're in our nice new home. We're in our dream home. And one or both of us lose our job.
Right.
So why don't we just, everybody's just kind of hide and wait. It's kind of it's a cliche, and we wear it out so often, but I can't think of a better cliche in this case, where everybody is just kind of hiding and waiting. Where's this going to go? It makes it terrible for the real estate industry. Because in the real estate industry, we don't want people to hide and wait. We want them out there.
Right.
We want them calling lenders. We want them shopping for the best interest rate, for the best mortgage rates. We want them calling realtors. We want them driving around looking at signs in yards. We want them driving around looking at subdivisions. We want them dreaming about their dream home. Well, not to sound like the Grim Reaper, but that's not happening right now.
Right.
Hopefully it's going to be a short time deal, but right now those things aren't happening, and real estate needs for folks to be in their cars and driving around looking at houses. Real estate needs people to be going to open houses and builders, getting online and shopping rates, getting their tax returns all bundled together and talking to mortgage lenders about, okay, what all do you need? What do I need to send you to get going on this? Where do I fill out my loan application? All that stuff could be done online. God, I remember years ago when you couldn't fill out a loan application online.
No.
You'd go to the bank.
Yeah.
Take a day off of work.
I know.
And and go back to the bank a half a dozen times because you forgot something,
Yeah, exactly.
Now people call me and they say, hey, Tom, I saw your sign on a house in the same subdivision that a friend of mine lives. We've always wanted to live there. What do I need to do? It was great to be able to tell people, well, the first thing you need to do is send me a pre-quote. Well, how do I do that? We'll spend 15 minutes in front of your computer. When we hang up here, send me your pre-qual, and I'll schedule a showing for that very same property today. Well, fantastic. We're going to do it all today? Yeah, we're going to do it all today. Well, if I like it, can we put in the offer to the seller? Absolutely. We might be in contract before dinner time.
Yeah.
It was a great experience in real estate, and it facilitated this boom in real estate that we've seen since probably around 2012. You couldn't get a sign in the yard, and you were already buried in contracts.
Yeah.
So,
I guess that shows some promise that one way or the other, it always bounces back. Which,
Oh, absolutely.
yeah,
It will come back. No doubt about it. We're at the freak out stage right now.
yeah.
But
One
it will
question.
come back.
One question I really want to ask you: when you talk back to 2008 till now, I know that there are people that are underwater with their mortgages, their horror stories, but there seem to be some areas that just also became insane. Like it didn't affect it, and almost in the prices. Like you look at California or the parts of Florida, especially like the Gulf Coast, like the real estate never really took a hit and just took off. And how did that happen? And also, I don't know, maybe I don't want to bombard you with too many questions, but my other question was, I know of there's people that made a killing in 2008 because they had cash and they bought a lot of real estate up for cheap, and then the prices increased over that time frame. So two things: why did some areas get hit hard and other areas seem to just continue to increase in value to where the common person can't even afford it? And then two, are there people that are going to be making a killing in this downturn, if there is a downturn?
Yeah, absolutely, absolutely, and it is one of the ebbs and flows of real estate, and it's why real estate always is in the best of times and in the worst of times. Real estate is always a good option. On the first part of your question, where we saw markets take the biggest hits, when you look at some of these communities outside of Vegas, are the ones that always come to my mind so often, where they built these beautiful subdivisions. They attracted all kinds of buyers to these communities. A lot of the people who bought these homes in these communities outside of Vegas were in the service industry. A lot of them just barely qualified for these homes, but new pathways and new products in borrowing were created in order to get these people into these homes. And then what happened when you had these communities that were primarily of that type of borrower in the service industry, barely qualified, it doesn't take a whole lot to knock the chair out from underneath these buyers, these homeowners, and they were just walking away from these homes in droves, to the point where you had entire communities and subdivisions outside of Vegas where you would have street after street after street of vacant homes, and maybe one or a handful of those homes were actually occupied. And there are still communities outside of Vegas where that has not changed, where these homes are they're just sitting there. They were just abandoned. They're bank products. The banks don't know what to do with them. Most of them, they've charged them off of their balance sheets. It's just a wasteland. And there wasn't even the buyers that would buy these bank products, these foreclosures and short sales, weren't touching them, because if they're buying them to buy and hold, to lease these properties out. Well, if there's no leasers, if there's no leasees of these properties, then even that secondary market isn't going to buy up those homes. What we're going to see now here in this market, once the foreclosure rates and the short sales start to hit the balance sheets, our hope is that there's going to be buyers out there to buy those bank properties, but there's going to have to be leasees for these properties before these buyers are going to come in who have cash. They're cash buyers. They're going to buy up these properties, but they're going to buy up these properties to hold and lease, not to turn around and sell them. They want to be landlords. They want to make their money as landlords, but they're going to be very suspicious too about, if they go into a community and they buy up a lot of these homes, if you see a lot of foreclosures, they're going to have to ask themselves, or they better be asking themselves, if I buy these houses, are there going to be renters for them? Or am I just buying up these houses get these bank-owned houses without having any renters for them? We saw that here with Harvey. subdivisions that had a lot of homes that were flooded.
Yeah.
And some of the buyers were able to sell them, or rather the homeowners were able to sell them because they had flood insurance. So they were able to sell them, pay off their mortgages, and come out whole. Well, they were selling their flooded houses to investors that were buying them up with the intentions of putting them back together and sticking tenants in there. Well, that happened a lot here after Harvey. And but what we're seeing now is there are so many of those properties that there's just not enough. There's not enough renters that are wanting to buy up these properties. We see subdivisions where you have lots and lots and lots of for rent signs, and there's just not enough renters to take on these properties. Well, I think that's going to change now. I think because a lot of people are flooding into the rental market because they don't want to risk getting into a mortgage.
Yeah.
And I think that this may be a win-win for these investors who gobbled up a lot of these properties after Harvey, and they've been on the market for a year or more looking for renters to move into them. Well, their ship may have come in.
Okay.
Because we're seeing in the market here in Harris County where rental properties flying off the market. I do a big lease business. I can't get my clients into the properties quick enough to view them to even get in a lease application. They're moving off the shelves that quick. And I think that that's a reaction from buyers saying, we don't want to get into a mortgage right now. We're not comfortable. We want to wait a year, but we still need somewhere to move to. And they're jumping into the rental market now. So if there's any silver lining to this is if you're a landlord, if you're holding a lot of rental properties that you've not been able to rent out because rents are very high, and borrowers are saying, well, why would I want to rent when I can own a house and my mortgage is going to be less than what the rent is? This may be what these investors who are holding these properties have been waiting for, because what I've seen here in Harris County is the rental market is exploding. And I think it is because buyers are unsure. They don't want to get in over their heads. So I know I've peppered a lot of stuff out there, but there is so much going on right now in the real estate market as it tries to find its footing again. And one of the places where it's going to find its footing is going to be in the rental market. A lot of folks who are thinking about buying a house, they're saying, no, let's wait. Let's wait another year and see where this goes. And they're going to decide to stay in the rental market.
Interesting.
So great for landlords.
Yeah. Well, our guest today is Tom Eickleberry, real estate expert. Along those lines, I mentioned it previously in our interview. You mentioned the hard-hit areas. Obviously, the Vegas area was slammed and other areas. But why is California so insane with their pricing? And why wasn't that affected? Will that ever get affected? Will those prices ever go down? I mean, it's absolute insanity. My son went to school out there and lived out there from time to time. He was actually coaching college baseball, and of course the season got canceled, so now he's back here. But why is it so crazy out there? Why it doesn't seem like 2008 really affected it.
You know, California is an example of location.
All right.
And folks just it seems kind of simplistic, but it really does matter. Folks, they love great weather. They like to be near the water. They like to be near anything that's cool. Wineries are cool. Waterfront property is cool. Los Angeles is cool. You know, metaphorically speaking, everybody just says, oh, man, that's so cool. You live in California. It's just cool.
But it doesn't make sense. How do people afford that?
Well, that's always been the thing that surprised me the most. But California, there are two economies in California. There are native Californians that just understand how to live and survive in California. And they live in parts of California that most people, they never see these parts of California. They only see the parts of California that draw public interest. The parts of California that draw public interest are the parts of California where you're going to see that home prices are the highest. Nobody's interested in the parts of California where the average home price is maybe $380,000.
Right. When you're talking inland, because, like Fresno, Bakersfield. Yeah,
absolutely. Absolutely. Places where most people just don't even, if they want to see that, they can stay right where they are.
Right.
But what you and I see so often when we think about California are the parts that they're much more commercial. They're much more sort of, oh, wow, did you see that house? It's $1 million. Well, how many square feet was it? 1,500 square feet. Well, where the hell is it? In a suburb of Los Angeles. Well, we even have that here in Houston. The parts of Houston, what we call the downtown neighborhoods, we have the same thing here. We have these little craftsman style bungalows where you can see downtown from your porch step. The houses are 1,500 square feet, 1,400 square feet. Very rarely anything over 1,500 square feet. These properties $1 million.
Yeah.
Because of where they are located. You're downtown. It's no different with California. The closer that you are to LA, the more expensive they're going to be. But native Californians, they don't live in those neighborhoods. If you ask them where they're at in relationship to Los Angeles, chances are they're going to tell you, oh, we're Los Angeles. That's 20 miles from us. Well, to a Houstonian, 20 miles is nothing. We go to a restaurant that's 20 miles away.
Right.
But in LA, it's quite a bit more. There's more to it. They're not going to drive 20 miles to a restaurant. They're going to eat right there in their neighborhoods. But I don't think that the formula is any different in California than it is in any other state. If you're close to LA, if you're close to West Hollywood, if you're close to the things that, again, like I say, that are really cool, you pay a big price for that. And we just we think in terms more of California because so much of what we see that is expensive and really chic is related to California, New York. But we see the same thing here in Houston and in Dallas. The closer we get to our cities, the closer you get to Dallas, look at the housing prices in Dallas. If you're close to Dallas, there's a neighborhood called Deerfield, which is very close to the Dallas business section. The prices are insane. A single-family home will cost you $1 million, just like here in Houston.
Yeah.
It'll cost you $1 million. In terms of California, what we always see with California is we always see the $1 million mansions. Well, they are what they are. We have River Oaks here. We have our multi-million dollar mansions. I just think there's something, California is kind of an easy reference point when people want to talk about the extravagant home prices. Everybody will always say, well, what about California? Well, right. California has all of the things that a lot of people want.
Yeah.
And it drives in supply and demand. It drives up the prices on those properties. But I do know people who live in California that their home prices aren't any more than what they would be if they were further outside of Chicago, if they were in Romeoville, if they were in Naperville. They're still Chicago neighborhoods. They're just affordable.
Yeah.
But if you ask somebody where you live, and they say, well, I live in Romeoville, they say, well, what's Romeoville?
Exactly.
Well, it's a suburb of Chicago.
Yeah.
Oh wow, the home prices must be really expensive there. No, not really. We're about, we're a little bit of a drive
Yeah.
from Chicago. So, but again, like I say, I just think that there's a lot of qualifiers when people ask about the housing prices in a particular state or a particular area. When you narrow it down to what someone's personal economy can afford, there's lots of places in California
Yeah.
that are affordable for the average Joe. They're just not going to be they're not going to be in the cool places. They're not going to be a 20-minute drive from LA.
Yeah.
It's probably going to be quite a bit more than that. So.
Once again, we're talking to Tom Eickleberry. Circling back to what's happening now with the coronavirus, COVID-19, what can buyers and sellers do to protect themselves right now that the industry as a whole is under assault?
Well, protecting yourself from the actual virus is a very big deal in real estate right now. It's very hard to show properties that are occupied. Sellers don't want buyers coming into their home, so that creates a challenge for sellers who are living in their home that are showing their home. And buyers they have their worries and concerns too. They obviously have the concerns about whether or not they even want to get involved in a mortgage at this time, but they're also worried about the shutdowns that we have here in Harris County, and in particular Houston. Our state and local officials, they don't want people out. They want everybody to stay in their homes. Now, real estate here in Texas is considered an essential business. Real estate agents are allowed to be out and about showing houses. I'm doing a big lease business now, so I am going out just about every day showing rental properties. But I'll be honest with you, I am wearing all of the protections that I can provide for myself so that I don't come in contact with the virus and that I don't bring it home to my family. I am wearing masks. I'm coming up with these creative ways on YouTube and things like that on how to make a mask, since the availability of masks it's just not there.
Yeah.
We want to save it for our first responders. We want to save it for our nurses. We don't want realtors running around using that important equipment that our first responders need. I'm wearing gloves. I'm wearing shoe protection. I'm using hand sanitizer. I'm doing all of these things when I'm out showing houses. And I tell you, we look like a real interesting lot when we show up at somebody's house and everybody's all got their gloves on and everybody's preparing themselves to walk into this house. You can't help but kind of chuckle a little bit and think, my God, what are we doing?
Yeah.
We're fixing to go in and look at a house, and we don't know who was in here before. We don't know who handled the keys, the doorknobs, the lock boxes. We don't know, we know if the home is occupied or not. But we're being very sensitive to the fact that our homes, just by the nature of being our homes, are full of germs.
Yeah.
Some not dangerous germs, but now we're encountering a virus that is very dangerous.
Yeah.
And we have to be very, very cognizant of the fact that we are walking into a home where we don't know what the health is of the people who live in the home, who was in the home before we went into the house, who touched the doorknob last, who touched the key box the last time, the key. So, we're asking for our buyers to not bring the whole family out. Yeah. Just bring the important ones. Don't bring the kids. Don't bring the aunts and the uncles, the grandparents. Limit the flow. New builders, their open houses, their model homes, they're closed unless you have an appointment. You can't, here in the greater Houston area, something that people love to do, they like to tour model homes.
Yeah.
Well, you can't do that anymore. You walk up to a model home, the door is locked, and you see a note on the door that says, we're doing things by appointment. by appointment only. Our title companies, they're not doing face-to-face closings anymore unless they absolutely have to. They're doing everything remotely now with mobile notaries and with the acceptance of electronic signatures. We're not going into title companies and all sitting around the table and talking about, oh, isn't this exciting? And where am I taking you guys to lunch after this closing? Well, that ship has sailed. We're not doing any of that anymore. So that's affecting the real estate business a great deal because you don't have that very familiar, touchy kind of way that most real estate agents, including myself, when I meet my clients, we're either shaking hands or we're hugging. How's the kids? How are you? God, it's good to see you. Where's the rest of the clan? Who else is coming? We're not doing any of that. And that's changed the landscape a great deal about the way that real estate is operating right now. It's very sterile. And real estate's never been that way, not in residential. In commercial, that's a different animal. It's always been very sterile. It's commercial. But when it comes to residential, it's always been very, very friendly, heartfelt, everybody shaking hands, and everything was communal use. Oh, here, use my pen. Oh, I have a pen. Here, use this,
Yeah.
That has all changed. And I've got a feeling that even after COVID-19 has gone away, a lot of these practices are still going to be in place. They're still going to be a very, until we have a vaccine that everybody's comfortable with, that, okay, I'm safe from this now. I'm not going to get this. I've got a feeling a lot of these practices are going to stay in place. We always thought it was so strange when we would look at Asian Pacific countries where on any given day, half of the population is walking around with a mask on. As Americans, we see that and we think, what's the matter with those people?
Yeah.
Well, I think we're going to start seeing that here in the United States a great deal more, especially on your major public transportation cities like New York and the Bay Area Transit, Boston, these cities where they really rely on their public transportation. Here in Houston, our public transportation is kind of novel. It's just like, we have a subway, but nobody uses it. It connects the medical district with downtown. But in cities where they really, really rely on it to move their population from point A to point B, I think the use of protective masks and gloves and sanitary approaches to people around them, I think that's here to stay.
Yeah.
I really do. I think that's here to stay. And as far as real estate is concerned right now, that's the way everybody is. I have to check with myself all the time, every time I'm stopping to look at a property, and it's like, okay, got to prepare myself to go look at this property, put my mask on, put my gloves on, I've got my hand sanitizer, okay, let's go.
Yeah.
And and like I said, I don't think that that's going to change anytime soon until we get a vaccine and folks really feel comfortable that they're safe from the virus. I think this distancing that we're employing, I don't see that going away anytime soon. I really don't.
Right. Possibly an easing of it, but no one really knows. I think,
nobody really knows. But
where
I
else?
do think that in your large cities, New York, Boston, the Bay Area, areas that we always think about their public transportation, even after there's a vaccine, there's going to be a segment of the population that's going to feel vulnerable to viruses, where they're going to continue for years to come, where they practice that kind of protection. Children who are just now being born into this world, it's going to be very commonplace for them, I think.
Yeah. Where
people you and I's age, it's still a little odd when we see it. But I have grandnieces and grandnephews that are coming into the world even as we speak. I have several on the way in 2020. that's going to be very commonplace
Yeah.
for them.
Anything positive you feel will come out of this?
I do. I absolutely do. I think the thing that we're going to see positive come out of all of this is folks are going to start getting their financial houses in order. People are really going to start saving. People are going to start living within their means. A lot of the folks who are going to see the financial victims of COVID are going to be the ones that they always live well beyond their means. It took two household incomes to afford the home on the best day. If one person in the house would lose their job or change jobs, their income would be reduced. Everything was suddenly now on the chopping block. Everything was at risk. I think folks are going to start saying to themselves, let's not live beyond our means. Let's be sure that if we have a two household income, that one income will handle the house payment, the car payment, the groceries. One income will handle all of those things. Real estate agents are great about living within their means because we see it. We see it all the time.
Yeah.
That how easy it is to lose the ability to pay your mortgage, to lose the ability to be able to afford your car. And I think probably what we're going to see is folks are really going to start doing an inventory, and they're going to be asking themselves, are we living within our means? If another incident like this comes along, can we afford our house payment? Can we afford our car payments? Can we afford our credit cards? Can we afford our debt? Do we have a cushion? You know, the cushion everybody's always talking about, it shocked me that all of those years that I was in restaurant business, there was no cushion. If I needed money, I just picked up an extra shift, or I took the closing shift on a Saturday night to make an extra $100. That was a cushion. Well, now, you know, if real estate has taught me anything, don't carry a lot of debt. Don't buy a home that's beyond your means. Ask yourself, if I lose my job, or if the other person in the house loses their job, whether it's your husband, your wife, whoever the person is bringing that second income into the house, if one or both of us lose our jobs, how big is our safety net?
Yeah.
Because right now, people can't draw unemployment because they can't even get into the unemployment office. The unemployment offices are closed. You can't file for unemployment on the phone. You can't do it on the computer. I mean, this shock to our whole way of living here in the United States, this vicarious kind of, you know, devil may care way of living. I think if anything comes out of this virus, this pandemic, is going to be just that. Folks are going to take an inventory and they're going to say, okay, what is important? Our family is important. Our lives are important. Our health is important. The roof over our head. Do we have a car that'll get us from point A to point B? Do we have enough groceries in the refrigerator? Do we have running water? Do we have electricity in our house? Those are going to be the things that folks are really going to start saying, these are the things that are important, and all of this other stuff, that stuff's only nice when we can afford to pay for it.
Yeah.
But when you can no longer afford to pay for it, and you're asking yourself, you know, well, if we have to let one of the cars go, which one do we let go? If we have to not pay our credit card bills, which credit card are we going to keep, and which one are we going to let go? How much of a hit will there be to our credits, and can we climb back out of it? You know, people are asking themselves, if I have an 800 credit score today, and I have to let one of the credit cards go, how much of a hit will I see to my credit score.
Well, that's a whole other.
You know,
I think all that needs to be reevaluated in light of these circumstances.
I
But,
do.
yeah,
I absolutely
not-
do. We need to start living much more within our means. And
But the
these
credit
types
score,
of
the credit score is such an arbitrary number that
oh,
maybe it should
God,
just
I
be
know.
thrown out of the window for the time being. Anyway,
I know where you're
Yeah.
going. Yeah,
Yeah.
absolutely. I've had that inner conversation with myself since all of this went down when I'm looking at credit scores and I'm just thinking, oh, you got to be kidding me. That's going to be the lifeblood on whether or not this family is going to survive or not. Is that 3-digit number that's
Right.
going to decide?
and that's where I believe that's where our politicians need to step in next to get us
I
back
agree
on
with
track.
you. I've always had an issue with credit scoring with the 3 credit reporting agencies and how they operate. That's an entirely different discussion, and I wouldn't be
Yeah.
the best person to have that
Agreed.
conversation with. But no, you're absolutely right. There does need to be some government intervention in the control that the credit score has over our daily lives. Absolutely.
Well, Tom, thank you so much for joining us. What's the best
Oh,
way
God,
for
thank
people?
you.
What's the best way for people to reach you?
The best way for people to reach me is they can go to pridestreetrealty.com. Pridestreetrealty.com is a great way to get a hold of me. Or you can always just call me on my phone, 713-201-5257, 713-201-5257. I love to talk to people. I'm a phone person, so, call me, 713-201-5257. I'll be happy to talk to you. If I know the answers to your questions, I'll give them to you. But more importantly, if I don't know the answers to your questions, I won't make it up. I'll tell you, I don't know the answer to that. I'm not the person to talk to you about that. So pridestreetrealty.com is a great way to get a hold of me, or call me at 713-201-5257.
All right, Tom. Well, thanks for joining us on Logical Logistics.
Gosh, thank you. It's been a pleasure. Good luck and God bless everybody out there.
And we'll see you next time on Logical Logistics.
Click the subscribe button for new videos every week and download us and review us on iTunes. Visit www.beslogistics.net for more logistics, transportation, and warehousing resources. Thanks for watching.